Most people enter the market trying to be clever. The real winners enter trying to be patient. If you're looking for fast money, this isn't for you. But if you want wealth that survives fear, noise, and decades, then these 6 rules will change how you see investing forever. Let me begin with a simple truth most people don't want to hear. The stock market is not a place to prove how smart you are. It's a place that quietly rewards those who can sit still, while everyone else is rushing around. Many people believe mastering the market means knowing when to buy, when to sell, and what will happen next. That's a comforting illusion, because the market doesn't care about predictions. It cares about behavior. The most successful investors are not the loudest, the fastest, or the most confident. They are the calmest. They know that money is not made by activity. It's made by judgment. So today, let's talk about 6 rules of investing. Not rules that promise excitement, but rules that build wealth slowly, quietly, and reliably. Rule 1, never invest in something you don't understand. If you can't explain how a business makes money in a few clear sentences, you have no business owning it. Complexity is often a disguise for risk. Clarity is protection. Rule 2, buy businesses, not tickers. Stocks are not lottery tickets. They represent real companies with real people, real products, and real decisions. When you invest, think like an owner, not a trader. Owners care about durability, not daily price movement. Rule 3, price is what you pay, value is what you get. A cheap stock is not always a good deal, and a great business is not always expensive. The goal is not to buy low, the goal is to buy right. Rule 4, your temperament matters more than your IQ. Markets rise, markets fall. That's not a flaw, that's the system. The real danger is panic. If you can stay calm when others are fearful, you already have an edge most people will never develop. Rule 5, time is your strongest ally. Compounding doesn't announce itself. It works quietly, year after year, while impatience destroys results. The longer you hold a great investment, the less important the starting point becomes. Rule 6, do nothing. Most of the time, this may be the hardest rule of all. Great investing is often about resisting the urge to act. The market rewards inactivity paired with wisdom, not constant motion. Mastering the market isn't about beating others, it's about mastering yourself, your fears, your greed, your impatience. When you understand that, investing stops being stressful and starts being powerful. And that's when the market finally starts working for you, instead of the other way around. The market has never been impressed by raw intelligence alone. Degrees, titles, complex formulas, none of these guarantee success once real money is on the line. What the market responds to again and again is something far less glamorous but far more powerful: discipline. Discipline is the ability to act according to principle, not emotion. It is the habit of doing the right thing even when it feels uncomfortable, boring, or lonely. In investing, discipline matters more than brilliance because markets are not exams to be solved. They are environments designed to test behavior. An intelligent investor may know exactly what should be done. A disciplined investor actually does it. Most losses in the market do not come from lack of knowledge. They come from moments when knowledge is overridden by fear or greed. People panic during downturns, sell at the worst possible time, and then stay out of the market long enough to miss the recovery. Others chase rising prices, convinced that this time is different, only to discover that enthusiasm does not protect against reality. None of this happens because people are stupid. It happens because emotions are stronger than plans when discipline is weak. Discipline begins with having a clear framework. Before money is invested, the rules must already be set. What will you buy? Why will you buy it? Under what conditions would you sell? Without these answers decided in advance, every market movement becomes a question mark, and uncertainty is where emotions take control. A disciplined investor understands that volatility is not the enemy. Volatility is the fee you pay for long-term returns. Prices will fluctuate, news will create noise, opinions will change daily. Discipline is what allows an investor to look at a falling price and ask, has the business changed? Instead of, how do I stop the pain? Intelligence often pushes people toward complexity. They want sophisticated strategies, clever timing, and constant adjustments. Discipline pulls in the opposite direction. It favors simplicity, consistency, and patience. The market does not reward how complicated your strategy is. It rewards how consistently you can stick to a good one. There is a quiet danger in being very smart. Smart people are excellent at justifying bad decisions. They can build convincing narratives around emotional reactions. They can explain why selling in fear was risk management or why buying at inflated prices was strategic positioning. Discipline removes the need for excuses because it removes impulsive decisions in the first place. One of the clearest examples of discipline over intelligence is the power of long-term holding. Anyone can understand compounding on paper. Few people can live with it in practice. It requires sitting through years where nothing seems to happen and moments where everything feels like it's falling apart. Intelligence understands the math. Discipline stays invested long enough for the math to matter. Discipline also means accepting that you will be wrong and being prepared for it. No investor avoids mistakes. The disciplined investor limits the damage. They don't double down out of pride. They don't abandon their strategy after one bad outcome. They learn, adjust carefully, and move on. The market constantly offers temptations, hot tips, trendy sectors, stories that promise easy gains. Intelligence might analyze these opportunities. Discipline often walks away. It understands that saying no is as important as saying yes. Another overlooked aspect of discipline is humility. The disciplined investor does not try to predict short-term movements. They accept uncertainty as part of the process. They know that the future cannot be controlled, only prepared for. This mindset protects capital far more effectively than confidence ever could. Discipline is also deeply connected to time. It respects the fact that meaningful results take years, not weeks. In a world addicted to instant feedback, discipline is the willingness to wait, to let good decisions unfold, to ignore the scoreboard until the game is actually over. The irony is that discipline often looks like inactivity. From the outside, it appears boring. From the inside, it requires constant self-control. Doing nothing when everyone else is doing something is not easy, but it is often the most profitable decision. Available. In the end, the market is not a contest of who knows the most. It is a test of who can remain rational under pressure, who can follow their own rules when it would be easier not to, who can stay calm when fear is contagious and excitement is misleading. Intelligence opens the door to investing. Discipline determines who stays in the room long enough to succeed. That is why, over decades, the market quietly rewards discipline and merely tolerates intelligence. One of the most expensive habits in investing is the need to predict. People want to know what will happen next, where the market is going, which sector will rise, which stock will double. This desire feels rational, even responsible, but in reality, it is where most investors quietly lose their advantage. Great investing does not begin with forecasting the future. It begins with understanding the present. Prediction assumes control. Understanding accepts reality. Markets are shaped by millions of participants, endless variables, and events no model can fully anticipate. Interest rates shift. Technologies evolve. Human behavior reacts in unpredictable ways. Trying to forecast all of this with precision is not investing. It is speculation disguised as confidence. Understanding, on the other hand, is grounded. It focuses on what can be known, how a business makes money, what drives its costs, why customers choose it, where its advantages come from, and what could realistically threaten it. An investor who understands a business does not need to guess what the market will do tomorrow. They care far more about whether the business will still matter 10 years from now. Prediction is fragile. It depends on being right at the right time. And even when a prediction is correct, timing can still ruin the outcome. You can be right about the direction and wrong about the moment, and the market will not forgive that mistake. Understanding is resilient. It allows an investor to hold through uncertainty because their conviction is based on substance, not sentiment. When prices move against them, they don't panic. They revisit the fundamentals. If the core reality hasn't changed, the decision doesn't change either. The urge to predict often comes from discomfort with uncertainty. People want clarity, certainty, reassurance. But the market does not offer certainty, only probabilities. Great investors make peace with that early. They stop asking, what will happen next? And start asking, what do I truly understand? Understanding narrows the field. Instead of chasing every opportunity, the investor focuses on a small circle of competence. This is not about knowing a little about everything. It's about knowing a lot about a few things. Within that circle, decisions become clearer, risks become more visible, and confidence becomes quieter but stronger. Predictors are constantly reacting. They adjust positions based on news, forecasts, and opinions. This creates activity, but not necessarily progress. Understanding leads to fewer decisions and better ones. It replaces motion with intention. One of the great advantages of understanding is patience. When you know why you own something, you don't feel pressure to act every time the price changes. You understand that markets fluctuate, but businesses evolve more slowly. Price is temporary. Value is built over time. Understanding also changes how you interpret bad news. Predictors see headlines and immediately reassess their outlook. Those who understand ask deeper questions. Is this a short-term issue or a structural problem? Does it affect earnings power or just sentiment? Is this noise or a signal? This distinction is critical. Most market movements are noise. Most news is already priced in. Understanding allows an investor to ignore what doesn't matter and pay attention to what does. Another danger of prediction is overconfidence. When people believe they can foresee outcomes, they take risks they don't fully appreciate. They confuse insight with certainty. Understanding keeps ego in check. It constantly reminds the investor of what they do not know and plans accordingly. Understanding also encourages margin of safety. Instead of assuming best-case scenarios, the investor builds in room for error. They accept that even well-understood businesses can face unexpected challenges. This humility is not weakness. It is protection. In practice, understanding requires work, but not the kind people expect. It's not about watching screens all day or following every market update. It's about reading, thinking, and asking the right questions. It's about resisting the urge to act until understanding is deep enough to justify action. Over time, this approach creates emotional stability. When others are anxious, the investor who understands feels grounded. When others are euphoric, they remain cautious. This emotional balance is not accidental. It is the natural result of decisions rooted in knowledge rather than forecasts. The market does not reward those who predict accurately once or twice. It rewards those who avoid major mistakes over decades. Understanding helps prevent those mistakes. Prediction often invites them. At its core, investing is not about being right today. It's about being consistently reasonable over time. Understanding makes that possible. So the next time the market asks you to guess, pause. Instead of predicting, ask whether you truly understand what you own and why you own it. If the answer is clear, the future does not need to be, because in the long run, the investor who understands deeply will always outperform the one who predicts loudly. In investing, people spend endless energy searching for the perfect stock, the perfect entry point, or the perfect strategy. What they overlook, again and again, is the most powerful asset they already possess: time. Time does not make headlines. It doesn't feel impressive. It works quietly, without urgency, without drama, and yet, over the long run, it has more influence on investment results than intelligence, timing, or even capital. Most investors underestimate time because its impact is gradual. The early years show little progress, returns feel slow, doubt creeps in. This is where impatience begins to erode good decisions. People abandon sound strategies not because they are wrong, but because they have not been given enough time to work. Time is what allows compounding to exist. Compounding is not magic. It is math combined with patience. Returns generate returns, which then generate more returns. But this chain reaction requires uninterrupted time. Break the chain too early and the true power is never revealed. What makes time so underrated is that it cannot be rushed. You cannot negotiate with it. You cannot accelerate it without increasing risk. The market will not reward urgency. It rewards endurance. Many investors make the mistake of focusing on short-term performance. They check prices daily, sometimes hourly. They measure success in weeks or months. But wealth is not built on short intervals. It is built through long stretches of consistency. Time smooths volatility, absorbs mistakes, and magnifies correct decisions. One of the greatest advantages an investor can have is simply starting early, not because early investors are smarter, but because they allow time to do the heavy lifting. A modest investment, given enough years, can outperform a larger investment that arrives late and demands immediate results. Time favors those who show up and Time also changes the nature of risk. In the short term, markets are unpredictable. Prices react to emotion, news, and speculation. In the long term, businesses reflect earnings, productivity, and value creation. Time shifts the balance away from randomness and toward fundamentals. This is why disciplined investors are rarely in a hurry. They understand that most of the reward comes in the later years, not the early ones. The curve of compounding is steepest at the end. Those who quit halfway never experience the payoff they were working toward. Time also forgives imperfection. No investor makes flawless decisions. Mistakes are inevitable, but given enough time, good habits can outweigh early errors. Time allows learning, adjustment, and recovery. As long as discipline remains intact, impatience, on the other hand, is expensive. It leads to excessive trading, emotional decisions, and constant strategy changes. Every attempt to speed up results introduces friction, taxes, fees, and missed opportunities. The market quietly transfers wealth from the impatient to the patient. Time also provides perspective. Short-term losses feel painful and personal. Viewed through a longer lens, they often become insignificant. What once seemed like a crisis becomes a small dip in a long upward trend. Time does not eliminate volatility, it reframes it. Another overlooked benefit of time is optionality. Long-term investors are not forced to act. They can wait for better opportunities, better prices, and better conditions. Those operating on short timelines often have no choice but to react. Time gives flexibility, and flexibility is power. Time also aligns investing with reality. Real businesses grow gradually. They innovate, adapt, and improve over years, not overnight. When your investment horizon matches the pace of business growth, your expectations become realistic. This alignment reduces frustration and increases conviction. There is also an emotional dimension to time. Waiting is uncomfortable. Doing nothing feels unproductive. But in investing, restraint is often the most productive action available. Time rewards those who can sit with uncertainty without needing immediate validation. One of the quiet truths of investing is that the biggest gains often come from holding, not buying or selling. The decision to stay invested through uncertainty is where time reveals its value. Those moments are not exciting, they are not celebrated, but they are decisive. Time is also the equalizer. It does not favor speed or sophistication. It favors consistency. A simple strategy applied over decades can outperform complex strategies applied inconsistently. Time amplifies simplicity when discipline is present. In the end, time is the most democratic asset in investing. Everyone receives it in the same way. One day at a time, what differs is how people use it. Some trade it for excitement. Others invest it for growth. The market does not reward those who demand quick results. It rewards those who respect time enough to let it work. And that is why time, though often ignored, remains the most powerful ally an investor can ever have.